Over the last 10 years, the S&P 500 has been doing really good. But experts now saying that this is about to end. In the past decade, the S&P 500 has had an annualized return of over 13.3% per year. And over the last 30 years, the S&P 500 did an average return of 9.9%. However, Goldman Sachs believes that the next decade will bring returns close to only 3%. To put this in perspective, if you would invest $500 per month for 30 years at 30.3% per year, you would end up with almost $2 million. But if you would invest that same $500 per month for 30 years at the new 3% rate, you would end up with only $289,000. And that's a huge difference, right? In the past 10 years, US stocks have outperformed the rest of the world. However, the decade of big gains has now come to a close, at least according to a new note from Goldman Sachs experts. They expect the S&P 500 total return of just 3% over the next 10 years. They say that the index extreme concentration is one key reason the S&P 500 will deliver such paltry returns. So what do they mean exactly by this? The statement about the S&P 500's extreme concentration means that a small number of large companies like Apple and Microsoft make up a significant portion of the index total value. And this concentration can lead to lower returns because if these dominant companies perform poorly, it can negatively impact the overall performance of the index. Essentially, they are saying if the big players struggle, the S&P 500 will not deliver strong returns in the future, even if other companies in the index are doing really well. So Goldman Sachs suggests that the equal weight S&P 500, which gives each company in the index the same weight, if it's big or small, it could outperform the traditional market cap weighted S&P 500 by 8% per year. And this means that since larger companies dominate the standard index, the equal weight version may provide much better returns by allowing smaller companies to add more value to the overall performance. Goldman says, our historical analysis show that it is extremely difficult for any firm to maintain high levels of sales growth and profit margins over sustained periods of time. And they also say that the earnings growth of the Magnificent Seven has already started to slow down from the rapid pace seen in the last 2 years. The group's profit growth is expected to drop just over 18% in the third quarter as year-over-year comparisons become more challenging. However, growth is anticipated to increase for the other 493 companies, which are projected to achieve double-digit earnings growth over the next 5 quarters, significantly narrowing the gap between these companies and the Magnificent Seven. So what does this mean for your portfolio? Let's take a closer look at the Vanguard S&P 500 ETF, the VOO, which has delivered a solid 13.33% annual return over the last 10 years. This ETF is market cap weighted, meaning the largest companies, often referred to as the Magnificent 10, dominate the index. These top 10 stocks account for about 30% of the S&P 500, which can lead to less diversification than you might expect. If there's indeed a bubble forming in AI or in the tech sector, this high concentration means high risks. Here you see how the market cap is weighted over all the companies. The first 1 to 100 companies, the largest, are 71% of the total index, meaning that the other 400 companies have less than 29% of the total index. When we analyze how market cap is weighted across all companies, it becomes clear that smaller companies have less influence on the overall performance. In contrast, when you look at the equal weight S&P 500, you will notice that all companies, including the smallest 20%, are given much more equal representation, right? So if you are interested in a more balanced approach, consider the Invesco S&P 500 equal weight ETF, the RSP. Over the last 10 years, the RSP has delivered an annual return of 10.87%. And yes, this results in a 2.46% difference per year compared to the VOO over the same period. But here's the critical question. Can the Big Ten continue to sustain the level of performance? History indicates that it's unlikely. This brings us to another option, the Vanguard Total Stock Market ETF, the VTI. This ETF offers broader exposure, allowing you to be more internationally diversified and tap into the potential of worldwide companies. But you can also take an equal weight or a market cap weighted S&P 500 and diversify your portfolio more into dividend ETFs like the SCHD, where you spread your investments into other segments of the market. In this video, I take a deeper dive into the SCHD. Ultimately, the choice of ETFs is yours. Just remember, while the most beautiful flowers may grow on the edge of a cliff, it's essential to consider the whole garden when deciding where to invest your money in. However, with this kind of information, it is essential to keep in mind the wisdom of Jack Bogle. He always emphasized that prediction about the stock market can be tricky and often is unreliable. That's why it's crucial to understand how to calculate the average stock market returns. This knowledge will help you make informed decisions regardless of the market's ups and downs. Here you see what Jack Bogle has to say about market returns.
I'll just take a moment maybe to talk about my methodology. And this methodology is so good and so popular that it has never been used by anybody but me. But for 25 years, I've been using the same methodology. So it's all what actually happened after prediction. And I divide the market, the market return, into its two sources. One is investment return, one is speculative return. What is investment return? Today's dividend yield plus whatever earnings growth we get in the future. You know, it's averaged about 5%, could get to 6%, 6 or 7%. It can't really be much higher than that. And unless you get a depression, it's not going to be much lower than 2. So there's not a lot of room to differ there. But I'm using right now for the next, the long-term average is about 5% earnings growth. So we take today's 2% dividend yield, and my guesstimate, gives us 6% investment return. The other part of it, which is the more troublesome part, is speculative return. And speculative return relates to valuations, which we can easily measure by changes in the price-earning multiple. And if PE goes from 10 to 20, that's 7% in a decade. I don't do anything short of a decade. If it goes from 10 to 20, that's 7% of extra return. And we got that in the 80s, and we got it again in the 90s. And we're not going to get it again, because PEs can go from 10 to 20 to 40, but I don't think they can go to 80, which would be required if you follow the math. Sorry to bother you with those numbers. So I think any responsible market predictor should look at these three elements of return, two elements of return, investment and speculation. And so if I expect the market return to be 12% or X. I accept, here's what the dividend yield is, we all know that. Here's my estimate for earnings growth. We can't be too far different on that. 3 or 4 percentage points would be a lot. And then here's my belief on the valuation of the market. And so I believe that we will probably go, PE in the market is about 25 times today. That PE is based on GAAP earnings, accounting earnings, and not operating earnings. Operating earnings are much higher, leaves out all the bad stuff. Always a good idea if you're promoting something. And if it goes to 18 times, say, that 6% that I gave you from investment return, take off 2 percentage points for the drop in the valuation, would give you about a 4% return in the stock market over the next decade. Now, we've been doing this in 10-year periods for 25 years. That means we have 15 actual predictions, and they have a correlation of about 0.81 with the actual returns. Some of the errors were fantastic that you couldn't imagine you could be so far off. And actually, my very first estimate was the worst one. And that, as I said, the market return would be about 11% in the decade of the 1990s, beginning 1990. And it turned out to be 18%. But by 2003, the 13-year return was 11% because the market went up, stopped at the high, and went down. So timing is a funny part of it. But I still go with that because it's the reality of life. And the question really today, the big question I think for the marketers, the market itself, or market experts, or investors for that matter, is will there be a reversion to the mean of the price-earnings multiple, or are we in some new lofty territory, a permanently high plateau?
So don't forget that the best thing to do is to invest your money for the long run and never have your money on the sideline, because we can't predict the stock market. When you invest, you will get rewarded for the risk you take, and over the long run, you will have greater returns on your investments. So if you want to take a deeper dive into the Vanguard Stock Market ETF, the VTI, to spread your investments and have more diversification, we have this video for you, and we dive into the performances and the rest of this ETF. See you in the next video.